Welcome to the Deep Dive. We're the show that, cuts through all that noise and information overload. Our goal, to give you the crucial insights you need, turning complex stuff into knowledge that's clear, engaging, and actually sticks. Today, we're diving deep into something really vital. It's about personal peace of mind, family security, but it's often misunderstood. Long-term care insurance. We're going to unpack why it's frankly more relevant than ever for you and how it fits strategically into your financial planning. But before we really get into the thick of it, just a quick reminder, this show draws its material from Farhat lectures. All the content, the examples, explanations, it all comes from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, definitely check out the website. You'll find extra practice questions, video lectures, lots of detailed support to really nail down what we talk about today. A special thanks, of course, to Professor Farhat for providing this valuable material. Okay, let's start big picture. How do we usually handle risks in life? I mean, we try to avoid them, right? Or, lessen the impact. But there's another strategy, isn't there? This idea of transferring risk. What exactly are we talking about there?
That's a great starting point. Transferring risk. Well, it's basically shifting a potential financial hit from yourself onto someone else. And like our source material points out, the most common way we do this is with an insurance contract. It's really the perfect setup for certain situations. Specifically, when an event is pretty unlikely to happen, that's the low frequency part. But if it does happen, the financial consequences are severe, really high. That's high severity.
Yeah.
Yeah, think about everyday examples. A building contractor, maybe. They transfer the risk of a big accident on site to an insurance company. Or, when you rent a car, you often take out that extra insurance policy.
Not just in case.
Exactly.
Yeah.
You hope you never need it, but if something bad happens, the cost could be, well, ruinous. So you pay a smaller predictable amount, the premium, to hand off that huge unpredictable risk. It's about buying some certainty.
No. Makes total sense. Okay, so let's apply that. Thinking about a really personal high-severity risk. What comes to mind is needing a lot of medical or personal care, as we get older and maybe face a serious illness. The cost there can be absolutely staggering, devastating, not just for you, but your whole family. So is this where long-term care insurance comes in, as the tool to transfer that specific kind of risk?
Precisely. That's exactly its purpose. Long-term care, or LTC insurance, is specialized coverage. It's designed specifically for this risk. It covers costs linked to long-term care services, and this is key services that your regular health insurance usually won't touch.
Ah, okay, so it fills a gap. What triggers it? How does it actually start paying out?
Good question. The triggers are quite specific. They really center on your ability to manage basic self-care. So one trigger is becoming cognitively impaired. That means, difficulty thinking clearly, maybe due to Alzheimer's or similar conditions. The other main trigger involves something called activities of daily living, or ADLs. There are 6 core activities.
ADLs? What are those exactly?
They are eating, bathing, getting dressed, using the toilet, transferring. That's like moving from a bed to a chair, or walking and maintaining continence. If a doctor certifies you can't do typically 2 out of those 6 without substantial help, your LTC policy would usually kick in.
Got it. 2 out of 6 or cognitive impairment.
Right. And the importance of this as a financial tool, well, it's huge. Consider the costs. We're talking potentially over $100,000 a year for a nursing home, maybe $60,000 or $70,000 just for significant home care.
Wow.
Yeah. Most families just can't absorb that kind of hit year after year. So LTC insurance provides that peace of mind. It stops those costs from wiping out savings. It also lessens the burden, financial and emotional, on your family. And it means you're not solely reliant on, frankly, pretty limited government program to shift some massive potential burden.
Okay, let's dig into that government program part, because I think a lot of people listening, maybe many people generally, just assume Medicare's got their back for long-term care. Is that really the case? If you're facing years of needing care, does Medicare cover it?
Yeah, that's a really common assumption. Understandable, but unfortunately, it's quite far from the truth. Medicare, specifically Part A, the hospital insurance part, does offer some coverage for care in what's called a skilled nursing facility, or SNF.
Okay, SNF, skilled nursing facility.
Right. But, and this is big, but the conditions to get that coverage are incredibly strict.
Sure.
It's like you have to meet all these requirements.
Okay, what are they?
Well, first, the care has to be medically necessary, and it has to be care that only an SNF can provide. So no home care under this rule, usually. Second, and this is crucial, you must have been in a hospital for at least 3 consecutive days before going to the SNF.
3 days in the hospital first. Okay.
Yeah. Third, You have to be admitted to the S&F pretty quickly after leaving the hospital, usually within 30 days. Fourth, the care in the S&F must be for the same condition you were treated for in the hospital.
Okay. That seems quite specific.
It is. And finally, a doctor has to certify that you actually need and are receiving skilled nursing care. That means care from trained medical professionals, not just help with daily living. But the really fundamental thing to grasp about Medicare here is its limitation. It's designed for short-term recovery and rehabilitation.
Short term.
Exactly. The goal is to get you better so you can go home, or maybe to a less intensive care setting. It is absolutely not designed for ongoing long-term custodial care.
Custodial care, meaning help with those ADLs we talked about, bathing, dressing.
Precisely. The kind of help someone might need for months or years, especially if their condition isn't expected to improve. Medicare just isn't built for that.
So what does Medicare cover in that S&F setting, timeline-wise?
Okay, so here's the timeline from the source material. For the first 20 days in an SNF, assuming you meet all those conditions.
A hospital stay, the medical necessity.
Right, assuming all that, for days 1 through 20, Medicare covers 100% of the cost. You pay nothing out of pocket.
That sounds pretty good initially.
It is, for that short period. Then, for days 21 through 100, Medicare still pays a large portion, but you have to pay a daily coinsurance amount.
Okay, so some cost sharing starts.
Correct. But here's the really critical part, the cliff edge, basically. After day 100,
Yes.
Medicare coverage for that SNF stay stops completely. Zero coverage from Medicare after day 100.
Wow. So from day 101 onwards, you're entirely on your own or relying on savings or LTC insurance.
Exactly. You or your family or your LTC insurance, if you have it, become responsible for the full cost. And remember those potential six-figure annual costs we mentioned? That's when they really hit home.
Okay, this is where it gets, I think, really crucial and probably quite scary for families dealing with certain conditions. What about those chronic progressive situations like Alzheimer's, other forms of dementia? Conditions where someone isn't getting better in the rehab sense and might need care for years, not just 100 days. What does Medicare do then?
You've hit on the exact critical gap. And yes, it can be devastating for families. The short answer is, Medicare does not cover long-term care in a nursing home for conditions like Alzheimer's or dementia, where the primary need is custodial care and improvement isn't expected.
So even if someone is in a nursing home, if the reason is primarily dementia and needing help with daily life, Medicare won't pay after that initial period, if at all.
That's generally correct, because the care needed is considered custodial help with ADLs, supervision rather than skilled nursing aimed at rehabilitation or recovery. Medicare's rules are very clear. It doesn't cover long-term custodial care. These conditions often require exactly that ongoing support, sometimes for many, many years, potentially permanently. And that type of care, focused on assistance and safety rather than active medical treatment for improvement, falls completely outside Medicare's mandate.
So this gap, this is really the reason people need to think about long-term care insurance.
It's the primary driver, yes. People see loved ones facing these situations. They encounter the limitations of Medicare firsthand, and they realize they need a different plan. LTC insurance is specifically designed to fill that void, to provide the financial resources for that extended custodial care that Medicare simply doesn't cover. It's for the long-haul scenarios.
It paints a very clear picture of why just relying on Medicare isn't a complete strategy.
Not for long-term needs, no. It's essential for acute care and short-term rehab, but it leaves a significant gap for chronic, long-term custodial care.
Okay, so we understand the need, the gap Medicare leaves. Let's pivot slightly to the financial side again, specifically taxes. If you have LTC insurance, are there any, financial breaks or things you need to consider from a tax perspective, especially for listeners managing their finances or maybe even studying this for exams?
Yes, absolutely. That's a practical and important angle. The tax treatment of LTC insurance has a couple of potentially beneficial aspects. First, let's talk about the benefits you might receive from the policy. If you need care and the policy pays out, those benefit payments are generally received tax-free. However, there's a limit. It's up to a certain amount per day. For example, back in 2023, that limit was $420 per day. Any benefits paid out up to that daily amount wouldn't be considered taxable income.
$420 a day, tax-free. That sounds helpful. Does that amount change?
It does. It's indexed for inflation, so it typically goes up each year to reflect the rising cost of care. But getting those funds tax-free is definitely a significant plus when you're facing high care expenses.
Okay, that's the benefits received. What about the money you pay for the premiums? Can you deduct those?
You Potentially can, yes. LTC insurance premiums can be treated as deductible medical expenses on Schedule A of your tax return if you itemize deductions.
If you itemize. Okay.
But there are two key hurdles or limitations you need to be aware of. The first is the general rule for all medical expenses. Your total qualified medical expenses, which include these LTC premiums, must add up to more than 7.5% of your adjusted gross income, your AGI.
The 7.5% AGI threshold. That can be tough to meet for many people.
It can be, yes, unless you have substantial medical costs in a given year.
Ugh.
But there's a second limitation specific to LTC premiums.
Okay, what's that?
The amount of the premium that you can actually count towards that medical expense deduction is capped based on your age. The IRS sets annual limits.
Age-based limits. How does that work?
For instance, using the 2023 figures again, if you are between 61 and 70 years old, the maximum amount of your LTC premium you could potentially deduct was $4,770 for the year. Younger people have lower limits, older people have higher limits.
Interesting. So even if your premium was, say, $6,000, if you were in that age bracket, only $4,777 could count towards the medical expense calculation.
Exactly. And like the daily benefit limit, these age-based premium deduction limits also get adjusted annually, usually upwards.
So summing up the tax side, benefits received are generally tax-free up to a daily limit, and premiums paid might be deductible, but only if you itemize, exceed the 7.5% AGI floor, and stay within the specific age-based cap for the premium amount itself.
That's a perfect summary. There are potential tax advantages, but they come with specific rules and limitations. It's not automatic, but it can provide some relief.
This has been incredibly clarifying. It really feels like we've shown that long-term care insurance isn't just, another insurance policy to think about. It's a genuinely strategic financial move. It tackles a risk that could be financially crippling, fills that very real gap left by Medicare, and ultimately offers significant peace of mind for you and your family down the road.
Absolutely. And thinking about all this, it leads to a pretty important question for everyone listening, I think. We're living longer, medical science keeps advancing, but that often means living longer with chronic conditions. So the question becomes, what concrete steps can you take proactively, starting today, to really secure your financial future and keep control over your care choices? How can you avoid being solely dependent on limited government programs or placing that burden entirely on your family?
That's a powerful thought to leave our listeners with. How do you plan proactively for that potential future? Thank you so much for walking us through that complex topic today. And thank you, our listener, for joining us on this deep dive into long-term care insurance. We really hope this helps you as you think about your own financial planning and future security. Until next time, stay informed.